Excellent. And you can see my screen?
Yep.
Perfect. Good evening, everyone. Thanks very much indeed for giving me the opportunity to talk to you tonight. As Stuart mentioned, my name is David Appleton. I work at a company called McDonald. We are a UK wealth manager. We've got the immense privilege and responsibility of investing a little over £17 billion of mainly UK individual savings, pensions, ISAs, etc. So my job, I co-manage a range of funds called the Cornelian Funds. We're effectively a range of investment solutions for financial advisors. So the likes of Stuart's firm can advise their clients to invest in one or a number of our funds, depending on their needs. And then we have the responsibility of building portfolios and helping clients meet their financial goals over time. So I've been doing this for almost 19 years, which makes me feel very, very old. But what I thought I would do today is maybe just give you a sense of what sustainability means for me as somebody who's at the coalface making investment decisions and having the responsibility of trying to steward your savings through time, and give you a sense of what's happened in the market and what does this actually mean, because I'm actually incredibly excited about where we are as an industry and where we're going. I think this is pretty revolutionary what's happening in my world in terms of the way that we think about what we're trying to do. I think we're moving away from a very, very narrow focus on short-term financial performance to a far more meaningful, broader set of objectives that really try to take into account all of the different impacts that investments can have, both negative and positive. And that makes my life much more interesting, much more complicated, but also much more rewarding. And I'm pretty passionate and enthusiastic about where we're going as an industry, although there's a lot to do. So just moving on to the next slide. Three kind of sections to my presentation, if you like. The first is just trying to give you a sense of the big picture, and that's where we've been and where we're going in terms of investment, the investment landscape, the capitalist system. I think there's big changes underway, and I'm going to try and bring that to life for you. Secondly, I'm going to move on to try and define what we mean by ESG integration. And I'll warn you that there's a lot of acronyms and buzzwords in the investment industry, and they seem to be expanding at a rate of knots at the moment around sustainability. ESG integration is basically my day job now, which is to take into account of all of these different non-financial factors when we're making investment decisions. And it's just got a fancy name, which is called ESG integration, but I'll come on to that in a bit more detail. And then finally, probably the most exciting bit that really goes to the heart of the kind of the challenge that you set for this, which is can investment sort of save the world, or can pensions save the world? I'm actually really positive about the opportunity set that's out there to really make a difference through our investments. And there's quite a lot of skepticism about, and maybe rightly, about the role that companies and investors can play, and the reputation of business sometimes isn't always the best. But from my perspective, I'm really excited about putting clients' capital to work in really, really impactful, productive investments. And I've got quite a few case studies, examples to share with you, hopefully to bring that to life. So just setting the scene, I've got the title here, Capitalism 1.0, Where Did We Go Wrong? And I look back over my career and through I've experienced quite a few volatile periods, the financial crisis and Brexit and all the rest of it. And what's quite clear, I think, when you look back, is that as a kind of community, we were very, very focused on just one thing, which was maximizing shareholder returns. So they call it the primacy of shareholders. So companies were being managed generally across the world to maximize profits for shareholders. And that didn't really matter if it came at the expense of other stakeholders. And what we have to realize is that businesses do not operate in a vacuum. Businesses are real things that operate in communities, and there are lots of different stakeholders that are touched by companies, whether it's employees, whether it's customers, whether it's the environment, whether it's governments, regulators, etc. There are a whole host of people and other things that have got an interest or interface with a company. And it's not always the case that shareholders' interests are aligned with other stakeholders. And if I think about the mistakes I've made in my career, and I think about some of the worst losses of companies, share prices collapsing, etc., pretty much all of them that I can think of have their roots in the wrong incentives. So employees having the wrong drivers to their behavior, the wrong culture, focusing too much on maximizing sales, maximizing profits, and sometimes making the wrong choices. And here on this slide, here's a number of companies where I would argue that terrible shareholder returns have been the result of these bad behaviors. So despite trying to maximize shareholder returns, actually it was the opposite, because companies end up taking far too much risk, and risks that shareholders didn't really understand. So, if you look at the banking sector, great example. If you think about why did banks get into so much trouble in the financial crisis, it was because they were being run with far too much leverage. All of the management teams were running the banks with very low levels of capital, very large balance sheets, not really understanding who they were lending to, chasing, loan growth targets, etc. Hence, when the world came to, had a big shock in the financial crisis, the banks couldn't cope. They didn't have the buffers, and they had to go cap in hand to governments, and it led to catastrophic losses for shareholders. But it was actually worse than that, because a lot of the ways in which banks have been trying to generate returns was not from lending. It was from aggressive cross-selling of products that people didn't need. And the PPI scandal, payment protection insurance, has cost Lloyds more than £30 billion in redress. Lloyds' entire capital base is currently £36 billion. So in the last decade, Lloyd has paid out almost 100% of its capital base in fines, effectively, because of bad behavior of their employees, because they had the wrong incentives. Likewise with BP, with the Macondo accident. I know there was lots of contributing factors to that, but undoubtedly the safety culture at BP wasn't what it should have been. And there were lots of lessons to be learned. BP is still paying $1.5 billion a quarter as they're in redress in terms of environmental liabilities, etc. Think about Carillion and Patisserie Valerie. These are two UK businesses which were audited by Big Four accountants, and yet went bust after realizing that the finance departments were effectively manipulating their accounts. Again, the wrong incentives, greed, trying to meet targets, and making the wrong judgments in terms of presenting a fair representation of the financial profile of a company. Wirecard, the biggest bankruptcy in Europe, 20 billion. This was a payments company that was actually a massive fraud. And Boohoo, the fast fashion retailer, which effectively has been sourcing its clothes from sweatshops in Leicestershire, an absolute disgrace. Again, they were just focused on getting the lowest price possible for their products. They weren't thinking about being a responsible retailer and sourcing in the right way, and maybe paying a little bit more for that t-shirt. So these are all examples of companies that because they were focusing on maximizing financial performance in the short term, ended up creating lasting and profound damage to shareholder value. And it's always the shareholder that pays the price. It's not the company management, it's the shareholders. So that is basically, without ranting too much, that's exactly what has been wrong with our system. And what I'm really happy about is that we are moving on from a lot. I'm not saying we'll ever be eradicated, but the focus of businesses and for investors is fundamentally changing into a much more sustainable model. So why is it changing? One of the reasons it's changing is that our customers are changing. There's clearly a big and rising acknowledgement across the world about that there are real sustainability challenges, the climate emergency, etc. People are understanding for the first time that there's a real consequence to their purchasing decisions, and that is ultimately going to lead to different purchasing decisions by consumers. They want their products to reflect their values, and it's not consistent across every product line. I'm not pretending it is, but you can see it in the food industry in terms of people recognizing the big environmental footprint that the meat industry, particularly cows, have, and the development of alternative meat products, like the McPlant, which I had today, very good. Fast fashion, sourcing, clothing becoming disposable rather than something which is a staple. That's an absurd position we've got into when you look at the environmental cost of making a t-shirt or making a pair of jeans. It's huge. The amount of water involved in making a pair of jeans is off the scale. Yet people throw away jeans because they've only worn them a couple of times. I think things are changing, and businesses have to respond to meet that changing consumer preference. And this chart here hopefully gets you a sense of how the industry is changing from an investment perspective. There's an organization called the UNPRI. This is the United Nations Principles for Responsible Investment. And this is effectively an investment industry body that sets a series of standards, if you're a fund manager, that you must meet to effectively align yourself with responsible principles of investment. And I'm proud to say that Brooks McDonald, we were quite late to the party, but we did sign up to the UNPRI last year. Here you can see over time the explosive growth in the number of firms that have signed up to become members of the UNPRI, and the amount of AUM, assets under management, that are now effectively managed under the principles of responsible investment, which are a very significant commitment. It effectively really fundamentally changes the way in which you invest. It makes it it's a non-discretionary set of principles where you have to be able to evidence that you're incorporating environmental, social, and governance issues into every investment decision, and that has to be pushed throughout your organization. So this is, you can see that there really has been a very significant growth in the number of firms that are operating under this new regime. So momentum is building up. There's still lots to go for, but I think this is hopefully giving you some evidence that this is not something that's just started in the last year or so. This has been a trend that's been building in our industry for a number of years. So ESG integration. This, I think, I've described it as the new normal, because I think what I think is happening in our industry is that you've got, at the moment, there's a lot of products that are being launched with an ESG badge on it. So specifically designed to cater to an investor that has got a strong preference for sustainable investing or particular preferences relating to that, rather than financial objectives. But I think and that's great, but I think what is happening at the same time is that the lines are perhaps blurring a little bit, because I think the whole industry that's managing non-ESG portfolios is also raising their game appreciably, because we've all got, it's now really becoming business as usual. And every firm in the UK, we're a well-regulated market. The FCA are very focused on ESG integration, and it's now an absolute regulatory must. This is really kind of number one for all firms, and this is a process. It's not an end point. It's very much a process. Firms are constantly trying to improve and change and do things better and address gaps, etc. But I thought here I'd just kind of flesh out what we mean by that. What this means is that I call it the systematic consideration of environmental, social, and governance factors into investment decisions. But what does that actually mean? Well, if you think about how the industry operated before, it was only 50% of the pie, if you like. All we were focusing on as analysts was financial outcomes. If I think back to all investment decisions, all of the modeling I've done on companies, etc., it's all about where's the share price going to go, where are earnings going to go, what are the drivers of that, etc. And quite short term as well. That's been absolutely the way in which our industry has approached the challenge of investing. ESG integration suddenly opens up all the other non-financial aspects of a business's operations, and you've got to form an opinion on these things. It means you've got to have new sets of data that tell you about carbon emissions and waste management gender diversity on boards and gender pay gaps, etc. So there's a huge new sphere of additional information that we have to take into account. And also we've got to think about the actual activities of that company. What are the products they're selling? Are these products that you're proud to sell? Are these companies operating in industries that you are happy to invest in? So that's where negative screening comes in that Stuart mentioned earlier. And that's effectively looking at the products and services that businesses sell and make, and trying to think about, well, which industries are we happy to invest in? And it's a really interesting area, because there's no right answers to. I don't think. I think there's some industries are really clear. It's very difficult to make a positive argument for tobacco companies, in my view. You know, they're selling new products which are less harmful, but overwhelmingly their sales and profits are dominated by kind of conventional tobacco. But there's others that are not so clear cut. So, you know, alcohol, for example. Clearly, alcohol does huge amounts of harm when consumed in unhealthy ways. But equally, for many, it's a really important part of socializing. And you know, many millions of people can successfully consume alcohol without any negative health consequences. So it's really difficult. Where do you draw that line? And probably one of the more fascinating debates is about fossil fuels. And there really is quite a kind of, I think the investment world is in danger of trying to outcompete itself to exclude more and more industries. And I think fossil fuels is one where we're really in danger of making some stupid decisions, because the idea that you address the climate emergency by just not investing in oil and gas companies, I think is not the right approach. Surely the only way to address this is to help those companies play a positive role in that transition, and moving away from, over time, oil and gas production to renewables and other sustainable fuels, etc. I think we're seeing at the moment, with the spike in power prices and gas prices, that if you don't undertake this in a managed way, the negative externalities on wider society are huge. It's the poorest who suffer the most when when electricity prices spike. These are complex issues. I'm not pretending they're not, but I just think there's some interesting debates to be had about excluding whole industries rather than working with those industries to help achieve positive outcomes. And then positive screening, which Stuart also talked about, that's a way of thinking about emphasizing those companies that are either selling products and services which have a positive impact, but also are operating in a really good way in terms of their risk management of ESG, or have got a clear pathway to improve. And that's where a lot of the hard work comes in when you're assessing companies, is comparing and contrasting companies, trying to work out those that are really getting to grips with the negative impacts that their business may have on the environment, that they understand the risk their specific business faces, and they've got clear and credible plans how to manage those risks and minimize them over time. And that's how I think about it. We're investing on a journey. You know, we've got a 5 to 10 year investment time horizon. If you can invest in companies where they've got a clear pathway to becoming, to reducing the negative impact on the environment or in society of their products and services and their operations, then over time that's going to be beneficial to our planet. And then finally, voting and engagement. And this comes down to this concept of stewardship, that we are, as investors, have an obligation to be a responsible steward of that capital. So if we invest in a company, we have voting rights, and we have the opportunity to engage with that company. It's incumbent upon us as owners of that business to try and help steward that company and push it in the right direction. And that's been a big focus. I think historically, meetings with companies would invariably be dominated by financial metrics. And I used to find it so tedious on calls with companies, listening to analysts, spending hours and hours and hours asking questions about minutiae about the next quarter's results. The nature of conversations that we're having now with companies are so much more interesting for us, more interesting for the management teams. Talking about how are you incentivizing your staff? What are you doing on retention? How are you trying to reduce your carbon emissions? These are really fascinating challenges that businesses are facing. This is real management. This is really interesting, fundamental stuff that management teams are much more interested about, rather than trying to work out where the next quarter sales are going. So then, in summary, capitalism 2.0, where are we going? Well, I think we're going in a really good direction. I think the investment industry is genuinely undergoing a radical transformation. There's a lot of stuff about greenwashing and all the rest of it, and I'm sure our industry has got a habit of ruining good things, launching far too many products with badly conceived, etc. But when I meet other analysts and other fund managers and management teams, I genuinely believe that there is a passion and a desire to try and do good things together and drive businesses in the right direction. Sustainability is absolutely now front of mind in corporate strategy. All businesses now have got lots of environmental and social metrics which are embedded in executive remuneration. These are clear targets and pathways that they've set themselves. Net zero on the environmental side. Increasingly, you're seeing net zero plans, clearly mapped out, really stretching, really difficult. It's going to require a lot of investment and fundamental changes, but it's worth it. But it's great to see, businesses taking this really seriously. And it's amazing how quickly this has happened. It's gone from being a nice to have to being an absolute essential and fundamental part of corporate strategy. For me as an investor, ESG analysis is now a core competence. It's not just for ethical investors. It's not just for ESG funds. It is absolutely part of the day-to-day job. And I'm delighted because it makes in my life much more meaningful and much more interesting as an investor. And what does it mean for you as investors? Well, I genuinely believe that it's going to lead to lower investment risk over time. Those examples I gave you earlier of catastrophic shareholder losses driven by bad behaviors, the wrong incentives, companies not behaving in a sustainable way, not taking into account the various stakeholders. I think ultimately the risk of loss is going to be lower. And I think hopefully over time that could result in better outcomes, superior risk-adjusted returns. That's not a forecast. Potentially, I'm not saying it's going to happen, but fundamentally, from the bottom up, that's a genuine belief that is going to be a consequence of this. The boom and bust cycles of the past, I think at the margin they're less likely to recur, and I think companies are going to be more enduring and more sustainable as a result. Now on to the really exciting part. Impact investing. Here I've got David Attenborough talking about the challenge that we all face, and he's absolutely right. We have, I think the global pandemic, to me, illustrated in some ways the best of our species. The amazing ability of the scientific community to focus their minds on creating a cure for coronavirus or a vaccine for coronavirus. Amazing how that was achieved so quickly with such focus. And I think what the point that Mr. Attenborough is making here is, if we apply that same focus to addressing the climate emergency, then that we potentially could do great things. And what I'm excited about is I see a lot of focus on this, and I see a lot of areas where we can play a really direct role in it as investors, and channel your savings to directly addressing the climate emergency. And I'm going to try and bring that to life. So here I've got a kind of a diagram that kind of gives you a sense of some of the opportunities that are available to investors. And these are all what's known as investment trusts. So these are basically funds listed on the stock exchange that raise money from investors and then invest them in real assets, so tangible investment. So if you think about the growth in renewable energy, there are I think almost 11 different investment trusts. I think there's 11 different investment trusts in the UK, all focused on investing in renewable energy. The one that we've got in our portfolio is Greencoat UK Wind. This fund owns about 5% of the UK's onshore and offshore wind power. It generates a yield to investors of more than 5%. And this effectively powers about 1.7 million homes with renewable energy. Again, that's taking investors' capital and directly financing the build out of renewable energy. Atrato On-Site Energy is a newer company for us, but it's quite exciting what they're doing. They're looking at installing rooftop solar panels onto industrial and commercial buildings. There's a little over 2.5 million square feet of south-facing commercial building roofs that have not got solar power on them at the moment. And that is a huge opportunity. And it's a huge opportunity because by having direct co-located power, it means that you eliminate the up to 50% losses that happen from distribution. Think about our energy network in the UK. It's very centralized. You've got big power stations, and then the power is to be taken and transported over transmission distribution lines vast distances before it gets to the end consumer.
David, I'm a little bit conscious of time.
Okay.
I guess you're very close to the end, are you?
I am, absolutely. I won't get into any much more detail.
Okay.
Going right across, apologies. Water and waste infrastructure, lots of opportunities to invest in recycling. For example, we own DS Smith, which is recycled corrugated packaging. You know, every Amazon parcel you get through your door is using their cardboard. That's another example of the sorts of things that you can invest into. Running out of time. Thames Tideway Tunnel is another one of ours, which is London Super Sewer. You know, an incredible piece of infrastructure, replacing the current Victorian system. That's going to have a huge lasting impact on London's river system. And then on the social side, we've got lots of investments in areas like medical centres, care homes, hospitals, schools, nurseries, etc. You know, these are essential, really important assets that we either own or finance in our funds. These are very highly impactful investments. I'm conscious that I've been speaking for far too long. Thanks very much indeed for listening, and I will hand back to the speaker.